In this episode of the Brisbane Property Podcast, we'll run through the PIPA investment survey results.
We are going to find out what's been happening over the last 12 months for property investors, where costs are rising, where sentiment is changing, who's been selling and where, and which markets are the most common for property investors to be investing in the next 12 months.
Welcome to the Brisbane Property Podcast with your hosts Melinda and Scott Jennison.
Hello, everyone, and welcome back to another episode of the Brisbane Property Podcast with Scott and Melinda Jennison. And today we're going to give you a bit of a summary of the 2025 PIPA Investment Sentiment Survey.
So for those that don't know, PIPA is the Property Investment Professionals of Australia, and every year now they have, for several years, they have been putting out a survey to property investors to get a snapshot view of what is happening in the market, what sentiment is, where people are selling, where people are buying, and it really does provide a holistic overview of what's happening in the property investment space nationwide. So the purpose of today's episode really is to summarise some of the key findings that came through from the results of this year's surveys, just to help us understand what shifts we're seeing in the property investment space and what that means for us as consumers in the market.
And we'll crunch some numbers and bring through the results. But interesting one to start with is that 60% of investors are saying the next 12 months is a good time to buy property.
And yet, we're being told otherwise in terms of, there's a property bubble, prices are too high, there's no stock. There's all of these reasons why we're hearing that people are not confident. And yet in the survey that does survey property investors themselves, 60% are saying that it is a good time to buy, and in fact they will be getting into the market in the next 12 months. So we can overlay that sentiment with what we're seeing in lending data at the moment, and there's been a huge shift in lending to property investors more recently as well. So there's definitely more optimism in the market for property investors, and we're seeing that play out in terms of the results from this report.
And a lot of numbers here, I think, that we're about to rattle off to everyone. Everyone knows that I'm the data person floating around, all our listeners. So we'll run through some, there's a lot of numbers and information coming through here. So hopefully everyone can make sense of this. Some interesting numbers. So investor activity, if we're looking at selling versus buying, let's run through. So 16.7% of investors sold at least one property in the past year.
Yeah, it is interesting. Obviously, in some capital city markets, especially Queensland, or rather Brisbane, Adelaide, Perth, we have seen really strong price increases over the last few years, and a lot of investors have been selling in some of these markets, but also across the country as a whole. So 16.7% have sold at least one property in the last 12 months. And what is significant about this number is that since the survey has been conducted, this is the highest exit rate ever recorded in these survey results. So across the history of the survey, never has it been this high. So in 2024, as an example, there were 14.1% of respondents who said they'd exited the market in that year. And in 2023, it was 12.1%. So there's an increasing trend for investors to be exiting the market. And perhaps this is aligned with higher property values and people cashing in.
So the long-term investors, they were the ones leading the exit. So 31% held property for 10 to 20 years, 29% for 3 to 7 years before selling.
And so what this means is that, people that potentially have held property investment assets for decades, they're now choosing to exit the market and cash in on the proceeds, I guess, from their equity uplift. So long-term investors are increasingly choosing to exit the market, and that's certainly come through in this year's PIPA survey results.
And where'd they go? That's probably the interesting thing. So who bought them? So the numbers we've got here, we've got 42% sold to other investors, and that's up from 2023. So 2023, there's 24%.
Can I just touch on that before we go on further? So we've talked about the fact that just more recently there's an increase in lending data to property investors. There's more property investors shifting into certain markets, and there's also a trend that we're seeing that there's a very high volume of property investors moving into markets very quickly and then exiting those markets very quickly. So we've seen that in the likes of Perth. We've seen that in Townsville. We're now seeing that in some other regional areas where a lot of investors, with the help of a lot of large buyers agencies across Australia, they shift into a market. They buy in that market, there's strong short-term capital appreciation, and then they exit that market, and a lot of the time those markets stabilise following. So we have seen, with those property investors that have sold just in the last 12 months, a big uptick in the number of those homes that have sold back to property investors. So as Scott said, in 2023, there were 24% of homes sold back to property investors, but this year, 42%. So there's been a big uptick.
Big uptick. And that obviously changes a lot when everyone goes and buys in the same location.
It does, yes.
So 37% were sold to owner-occupiers and 25% to first home buyers.
So that percentage, I guess, in terms of 37 plus 25 is slightly below the long-term trend of owner-occupier purchases to investor purchases. Generally, it's around 70% to 30%. 70% of properties sell to owner-occupiers and 30% to investors, although we are starting to see a shift, and it is in line with these numbers. So what that means is that, we're still seeing investment properties replaced by owner-occupiers, because remember, these are investment properties that were sold. And I know just in our team in the last couple of weeks under multiple offer here in Brisbane, there have been times where we have represented a property investor that the owner has chosen to sell to the first home buyer or the owner-occupier through principal mainly, which, is absolutely fine from our perspective. Sometimes owners will choose to sell to other owner-occupiers because they don't want an investor to purchase their property. And we're starting to see that play out in the market as well, which, is all good and well because it does get those home buyers into the market, but it means there's one less investment property available for tenants as well.
Yep. So on the buying side, 28% purchased in the past 12 months. So that's up as well from 2024, where it was 24%, but still well below the levels of 2022, which was 37%.
So in 2022, that was that post-COVID boom. We saw a lot of investor activity getting into the market. But yes, certainly, in 2024, only 24%, it's increased to 28% of investors now moving back into the market or people purchasing investment properties. So it's interesting because we were told a couple of years ago as interest rates were increasing that it's Armageddon and, we're going to have a crash and no one's going to be able to afford their mortgages. And yet we've seen this uptick in the number of people that are moving back into the market. So it just goes to show that sometimes we can't believe everything that we hear in the media, and we need to look at the fundamentals to understand what's really going to happen on the ground.
So if we look at where investors are selling and buying, so location-wise, so some selling locations, Melbourne, 22.1%, Brisbane, 19.7%, Perth, 11%. And then we jump into regional Queensland, which spiked pretty sharp, actually, 15.8%. And then Sydney dropped to just 6.3% from 14.9% last year.
So there's a lot of numbers here, and we just want to break that down because we don't want you to get, flooded in numbers. But what this basically means is that Melbourne and Brisbane predominantly saw the most investors exiting the market in the last 12 months. And regional Queensland also spiked sharply. Now, a lot of that short-term growth in some regional areas perhaps resulted in some investor uncertainty, and they decided to exit the market while prices were still high. But what this means, and if I can bring it back to what's relevant to Brisbane and certainly Queensland, is that combined in our regional areas and in our capital city markets, we've actually got a huge volume of investors that have exited the market. And what that means is that the investment stock is shrinking. That is the investment properties that are available to rent. Now, we already have strong or record low vacancy rates, and that means that there's not enough properties available to rent for the people that need to rent a property to call home. And so with this small shrinkage again in the supply of rental properties, it's going to put more pressure on rents. If we've got fewer rental properties to rent and more demand coming into the market because of interstate migration and household formation and young adults leaving home and going into the rental market, we have that consistent growing demand, and yet we're seeing this supply shrink because mum and dad investors are the people that supply rental accommodation to Queenslanders. The government supplies less than 5%. So, this is a structural shift that we need to be mindful of. If it keeps going in this direction, we will see rents continue to soar because we need more rental accommodation.
So obviously when we overlay then the selling locations and we look at the buying locations, so where investors are buying, Melbourne is surged there. They've gone up 41%, up from 26% last year.
Yeah, everybody wants to buy in Melbourne, and it's a counter-cyclical market, obviously, where a lot of other capital city markets have surged ahead in recent years. Melbourne has underperformed relative to other markets. And so, it's really deviated from that long-term trend, and people are seeing that as an opportunistic place to buy. Let's not forget the headwinds for Melbourne's market. Obviously, there's been a lot of political instability. There's been, land tax changes and a lot of other headwinds that have caused investors to drop out of that market. But yet there's definitely interest, with 41% now saying it's the best place to buy.
Brisbane stayed steady. So Brisbane's still 16.5%. Perth was down. They were on top in 2023, so they're down to 9.2%. Regional Queensland, 8%. Regional New South Wales, 5.5%. And regional Victoria, 4.1%.
So obviously investors are still dispersed around the nation. They're looking at lots of different areas, probably for lots of different reasons. But yes, a big focus on Melbourne at the moment. So if you're an investor looking at Melbourne, it looks like you're going to be competing against lots of other investors to get into that market if these survey results play out on the ground.
So a bit of investor pressure, so costs and cash flow. So the costs are obviously climbing in this side of things.
They are. So holding costs for property, it's probably no surprise to anyone who listens to this podcast that the holding costs are up. Between 11 and 20%. Now, 39% of respondents to this survey said that their holding costs have increased by this margin, 11 to 20%. That's a huge increase. Now, of course, that is partly due to interest rate rises, but also the cost of holding the asset. So obviously, rates have increased. You've got property management fees potentially increasing as rents increase. You've also got other costs associated with holding the asset increasing as well, maintenance, etc. So, these are big additional expenses that landlords have to factor in into their cash flows.
And 21% said that the costs have rose 21 to 41% as well.
And then 5% of survey respondents said costs had increased 41 to 60%. Now, obviously, the cost increase may be relative to the property price or the property value. So those that are reporting that their holding costs have increased between 40 and 60%, perhaps they have lower value properties, and the maintenance costs associated with ensuring those properties are meeting local tenancy standards, they've escalated and they're causing more out of pocket expenses for property investors. These are the things that are critical to understand if you're looking at an asset. It's not just about what you pay and what the potential performance is how much is it going to cost me to hold this asset, and how much is it going to cost me to ensure that the asset remains rentable based on local tenancy laws. And that's something that obviously a good buyer's agent should be able to advise their clients on.
And it's interesting when you look at this, 36% describe the cash flow as tight, with 8% dipping into their savings to cover shortfalls.
So this is a really interesting result that's come out of the survey. For property investors to provide private accommodation to tenants, they're now dipping into their savings. 8% of those property investors are actually dipping into their savings to hold on to these rental properties. Now, I would say with those sorts of numbers, that 8% of property investors are likely to consider whether it's worth holding the asset or whether it's worth divesting and selling out, because, their savings really is not there potentially to be paying for the cost of holding an investment property. So yes, cash flow can be tight on property investors, and that's something that's come out in the survey as well. But it is important to note that if you're dipping into savings, it's likely that they're the property investors that are most at risk and likely to sell in the next 12 months.
It's interesting when they talk about the nasty landlord, isn't it? Putting all these costs. And on the back of that, 65% passed on only 10% or less of increased costs to the tenants.
Via rent hikes. Well, the reality is, and I think, let me make this very clear, as landlords, we cannot just increase rents and expect that a tenant will pay the increased cost just because our costs have increased. Rents are determined by the market. The rents are determined by what a tenant is willing to pay and what a landlord is willing to accept. So just because a landlord proposes to increase rent, if the market can't support rent at that level, they're not actually going to get a tenant. So we have to be realistic about what this means. And as landlords, our intent is never to cover the cost of holding the asset, but it is the intent to actually ensure that our property is achieving market rent relative to other properties in the area.
So the cash flow balance, 56% in negative cash flow. That's down from 64% last year, and only 26% positive cash flow.
Now, this is obviously something that a lot of people focus on at time of purchase. Now, a lot of these survey respondents may have held assets for a very long time as well. So some of the positive cash flow assets that are captured within these survey results are likely to be from investors that have held that asset for a long period of time. Right now, with interest rates sitting around in the high 5% for property investors, some are still locked in at interest rates above 6%. It is not surprising that cash flow is negative because the yields in most areas are sitting below 5%. And in fact, most capital city markets below 4% unless you're in the unit market. So these things matter. It's also a function of how you're structuring your finance to determine the cash flow position as well. But interesting results that the majority of investors, it is costing them to hold these investment assets.
So this next section about policy and regulations, this is quite interesting. Investor confidence under threat, they're saying, but nearly 53% would stop investing if negative gearing was changed.
This is big because there's so much talk right now by the government in terms of what they may or may not do in relation to negative gearing. We saw it come in as a potential change to an election. What was that, about 6-7 years ago? Labor got voted out at that time. Yep. They didn't actually win the seat, but they were trying to propose negative gearing changes. 53% of property investors would stop investing if negative gearing was changed. That's significant because that is a fundamental shift in the number of rental properties potentially being brought into the market to provide accommodation for tenants. So I think that governments do need to err on the side of caution if they're going to play with negative gearing, if that is the sentiment indeed from property investors.
It's interesting, some of these, and we'll come back to them as well, but some of the biggest concerns that we've got on here is 91% talk about government interference.
Yeah.
And I think that's huge when you look at some of the things, the main topics that they're talking about, but 91% for government interference into property.
And look, I think that's the thing. When we're investing in property, obviously we're wanting a level of control over the asset that we have put our money into. So when governments change policies that impacts us, or they put rental caps in place that impacts on the ability for us to generate income from the asset that we have invested our money in, regulation changes obviously can increase costs. And these are uncertainties. And what people don't want is uncertainty when they're investing into certain asset classes. One conversation that's been floating around just previously as well is in relation to capital gains tax changes. So for most people, you would know right now, for a property investor, if you hold an asset more than 12 months, you actually get a 50% reduction in the capital gains tax obligation. So what that means is that if you buy in 2025 and you sell in 2027, 50% of that capital gain will be tax-free and the balance will be assessed at your marginal tax rate. So that's the way the current legislation works. There has been talk in the market about potentially bringing in reduced concessions for capital gains tax to encourage people to hold assets long-term and to discourage short-term speculation. And what that means is that in order to achieve a capital gains tax rate concession of 50%, you may need to hold the asset longer. Now, that's something that I would support personally, because people that move into markets and exit very quickly shouldn't be entitled to the same tax concessions as those that are investing long-term, because it's the long-term investors that are providing that rental accommodation for property investors. So the survey here at PIPA indicated that 35% of property investors would actually exit the market if capital gains tax concessions were reduced. So that's interesting, because that indicates to me that 35% of property investors are not long-term investors but short-term investors. And I think that is something that we need to be mindful of as well.
On the big concerns, I mentioned the government interference. 70% inability to pass on higher costs, 66% blowouts in holding costs.
Similar, yep.
And 47% negative public perception of investors.
It is a shame that people have this negative public perception of property investors, and that comes through from the media. So I think we need to be mindful that property investors provide rental accommodation for millions of Australians that can't afford to purchase their own home. So, if we're actually providing negative publicity and the perception of us as property investors is negative, it's a bit of a kick in the guts, actually, given, the very important role that we do play in housing other fellow Australians.
64% were unaware of Victorians' new vacant land tax, and 60% said they had limited knowledge of tenancy law changes.
Yeah, see, that in itself is a huge concern, because if property investors are not aware of any changes to minimum housing standards, for example, that's a concern. We might not be maintaining our investment homes to a level that is acceptable based on new laws and legislation. I think not only government but property managers do have some level of responsibility in communicating that to landlords. And then, of course, as landlords, it is our responsibility to act upon the information that we're provided with, so that we are ensuring that the accommodation we're providing is compliant and it does meet minimum housing standards.
State sentiment. Interesting one, this one. So the worst, Victoria, ACT, New South Wales, and the best was WA and Queensland.
Look, this is the second consecutive year now that Victoria was named the least accommodating state for property investors. This year it was followed by the ACT and New South Wales. So the jurisdictions here, they were voted, or they were consistently viewed as being hostile to property investments. So policies were perceived as being punitive or overly restrictive. And that's really interesting, because on the reverse side of that, the states that were considered the best for property investors were Western Australia and Queensland. So the margin between the polls is significant. It does reflect the broader divergence in how people are perceiving property investment in different parts of Australia. And I think that also shifts sentiment as well. And we've certainly seen that play out in terms of where people have been focused on buying, as well as where people have been exiting markets over the last 12 months.
And looking forward, so signs of optimism. So 59% believe the next 12 months is a good time to buy, and that's up from 46% in 2024.
And yet we've had this strong price growth in the last 12 months. Yep. And in fact, in the last few months, we've had very strong price growth, and this is nationwide. We've seen most markets move into positive growth territory. So sentiment can shift when markets are going very well. I know the Warren Buffett theory, be greedy when others are fearful and be fearful when others are greedy. It's not playing out in these survey results, because the market is strong and people genuinely believe that the next 12 months is a good time to buy, or 59% of people believe that anyway.
And the main reason that they see this opportunity, long-term capital growth, 70%, population growth, 59%, tight supply and low vacancy rates, 42%.
And look, these are options that people that complete the survey have to complete. So, people are still seeing that opportunity for long-term capital growth. And I think we cannot underestimate the fact that Australia is a different property market to many around the world. But I think also not all land in Australia and not all locations in Australia are created equally. And I think people must understand that long-term capital growth, potentially will vary depending on where you buy and what you buy, and also when you're getting into different markets as well. So, keep that in mind. But, population growth, again, it's not distributed evenly across the country. It's only one factor that impacts on demand for property, but certainly tight supply and low vacancy rates. If we don't have enough properties to buy, and we're looking in areas where demand is high, it is likely we'll continue to see that price pressure.
And looking to buy again in the future, we've got 41%, and that's slightly down from 44% last year.
And look, property investors typically, they don't stop at one. Most people have a plan to continue to accumulate another one or two. Obviously, there's some people that want to accumulate a lot more than that. But for most people, one or two quality assets in a portfolio is sufficient, along with other retirement savings to set them up for the future.
Lots of numbers.
There are lots of numbers, yes.
I hope we didn't throw too many numbers around through there. But look, that gives you a bit of an idea, obviously, of what some investors are thinking as well.
Yeah, of course. And one thing I will say, because PIPA, or the Property Investment Professionals of Australia, they are the professional body that also provides the option for people within our industry to upskill and become qualified property investment advisors. One thing that's also come out in the survey results is that 94% of respondents said that property investment advisors should have formal training. Now, it is interesting. We see it all the time on Facebook and Instagram and, TikTok, a lot of people giving, property investment advice. And some of those people giving property investment advice are actually erring on giving financial advice, which is illegal because you need a financial license. You need a license to give financial advice. But property investment advice is not regulated. And so that's why we see so many people spruiking different options, different ideas. And yet we all think that it should be something that needs formal training. So that's something interesting that's come out of the survey. And, one of the other things that's come out of the survey is just at the moment, only 41% of property investors actually sought advice from a qualified property investment advisor in the last year. So even though 94% of people say formal qualification is important, out of those respondents, only 41% actually dug out and found a qualified property investment advisor to partner with. So there's still a gap in terms of what we say we want and what we add, the actions that we take. And I think that people can protect themselves by ensuring that they bridge that gap.
I think that's crazy. That's my view. I've talked about this so many times before about using people with qualifications to help invest into property. I still don't understand why people don't. I'm a bit shocked that 94% said they need formal training. I think that should be 100%. And I'm really shocked that only 41% sought advice from QPIAs. I think that should be higher as well. But
yeah,
that's my thoughts on it. I think avoid making mistakes. So get the right advice when you're looking to invest a lot of money as well.
So just in summary, I think that the PIPA survey really does provide a snapshot view of what's happening in the market in 2025, especially for property investors. And it does paint a really vivid picture. We've seen investors exit certain markets. We've seen other investors quite optimistic about getting into other markets. But importantly, investors are continuing to navigate rising costs. They're continuing to navigate policy changes, uncertainties around potential policy changes as well, and shifting market dynamics. Obviously, we do have different supply levels in different markets, different vacancy rates in different markets, and different demand rates in different markets. So I think that any reform that government is proposing in terms of changes to things like negative gearing and capital gains tax needs to be treated with a certain amount of caution, simply because, we don't want to impact on the investors that do provide the private accommodation for most tenants across Australia. And I think there's a fine line between, changing policy and changing sentiment, which could actually damage the fundamentals within the market.
Perfect. Well, that's a bit of a wrap on the PIPA investment sentiment survey for this year, for 2025. Hopefully everyone got some information out of there, lots of numbers, lots of percentages, etc. But it is very interesting to run through each year when this survey is completed as well. So thanks very much for listening. I will let Melinda wrap it up as I normally do. Until next week, take care and bye for now.
Yes, thanks once again for joining us on the Brisbane Property Podcast. We hope you have enjoyed this summary of the PIPA 2025 Investor Sentiment Survey results. As always, if you've enjoyed this episode, please share with family and friends, or alternatively, please leave us a review on your favourite podcast player. We hope you have a fabulous week, and we'll look forward to speaking with you again soon. Until then, bye for now.